After 48 years of analysis, here's my take. In this episode, I'm going to address the question, what constitutes the perfect investment? Get ready. It's probably not what you think, but I've been around the block and I'm going to share with you what I think is absolutely the perfect investment. So my name's Doug Andrew. I've been a financial strategist, a tax minimization specialist now for more than 48 years, helping thousands of people optimize their financial assets, minimize taxes, and prepare for long-term goals financially, such as retirement, but a lot of other goals like college funding for their kids or grandkids, working capital for business, real estate management, on and on and on. I've been very fortunate in my life to have met many, many successful people, multi-millionaires, several billionaires. And there's some common denominators among those who are super successful. But when it comes to money, many of them understand some basics about how money works that a lot of Americans never do learn. And so in this episode, I'm going to simplify what constitutes the perfect investment based on certain criteria that I have learned through the School of Hard Knocks. And it never ceases to amaze me how many financial advisors take decades to learn the proper priority of these key elements of a prudent or perfect investment. Are you ready? So, when we talk about the perfect investment or a prudent investment, there are some key elements that constitute a perfect investment. So many financial advisors get these out of whack. They get them out of priority. I am going to share them with you right now in order of priority. Number one key element of a prudent or perfect investment is liquidity. The ability to access your money when you need it. I'm talking about with an electronic funds transfer or a phone call. I am not talking about a drive-up window at a bank or credit union down on the corner. That may be convenience, that's not liquidity. Sometimes banks and credit unions, if push came to shove, could tell you sorry if you ask for your money out of the bank for up to 6 months. I want my money in a position where I can access it. I want my money where the banks put your money. Okay? And a lot of people don't understand where banks and credit unions put their tier 1 assets for liquidity and safety. They will take our money that we deposit in them and they'll take their tier 1 assets. Now, a tier 1 asset is money that they have to have liquid, on hand, safe in the event of an emergency. And in case we all panic and we run to the bank to get our money. They don't have all of our money in a vault. So where do they put their money so it's liquid? They put it into financial institutions that are ranked usually 5 or 6 notches higher in safety than they are. A lot of banks are only rated BBB by Standard & Poor's. Most legal reserve insurance companies where I put my money, because I bypass the middleman, the bank, are rated AA and AAA. So they increase the safety by 5 or 6 notches higher, but the rate of return by 5 times. Banks pay us 1% interest. Every million that we deposit in a bank, they pay $10,000 a year. They turn around and put it into these insurance companies and earn at least 5%. How much more is 5 than 1? It's 500% more. It's 5 times. Every $10,000 they pay to borrow your money, they earn $50,000, which is 5 times that. That's a 500% return. You can do that yourself, by the way. But see, liquidity is number one. When things happen out of our control, I have learned the hard way, you want to be able to access your money. So I just put my money where banks put your money to where I can access it if something really happens serious in America and we have a collapse or a run on the banks. Does that make sense? Second key element of a prudent investment, safety. Now, when we say the word safety, I'm not talking about just the safety of the institution, like what I just shared, that it's rated higher in safety by S&P and the various rating agencies. I want to have safety of principle. So it's sort of like two prongs. Safety of principle means that if I set aside, $1,000, 10,000, 100,000, a million, 10 million, I don't want to jeopardize whatever I set aside. I do not want to lose that principle. But I go one step further. Any year that I make money, I want whatever I make in any given year to become newly protected principal, so that in the future I will not lose any of the money I made in past years. Now, I say that, and some financial advisors who are so used to just money in the market go, "Whoa, what do you mean? How do you do that? The market goes up and goes down. I mean, your money in a mutual fund could be worth $1 million one year, and the next year it could be worth $600,000. Yep, that's what happened in 2008. Not with people who used the perfect investment I'm talking about. In 2008, they didn't lose a dime. They still had their million. And they started making money again the first 90 days of 2009. So the perfect investment, you want safety of principle. And any year you make money, you want to lock in that gain and reset so you never lose in future years money you made in previous years. That's the second key element. Now, I've done these in order. Number 1's liquidity. Number 2, safety. 3 is rate of return. Now, a lot of people think, wait a minute, I've been going after rate of return first. Yeah, a lot of investors and unfortunately advisors put rate of return as the number 1 goal. Nope, it's third down the list if we're talking about the key elements of a prudent investment. Now, when we talk about rate of return, we don't need pie in the sky rates of return, 20, 30, 40, 50%. Yet my favorite vehicle, which I call the Laser Fund, this year, the recording of this episode is the year 2021, we've had many clients lock in gains of 25%, 32%, 61.33% and higher, tax-free. That's actually the 4th key element of a prudent investment. It's sort of like icing on the cake. The first 3 are liquidity, safety, and earning a predictable rate of return. And I'm talking about an average rate of return of 7 to 10%. Some years it will be higher. Some years you will not make anything, but you will not lose if you use indexing. So that protects you from the negative impact of market volatility. You want a predictable rate of return no matter what the stock market does by not having your money at risk in the market. You want to benefit from the upside if the market is doing well, but not lose if the market goes down. And the only way to accomplish that is by not having your money invested in the market. You link your returns to the things in the market, but your money is safely tucked in an insurance company, and they are paying you whatever the market does if the market goes up. And if the market goes down, they don't pay you anything, but you didn't lose because they're only taking the interest on your money to buy upside options, and this is a strategy called indexing. Now, you can learn about this and how you can earn predictable rates of return, just 7 to 10%. But the 4th key element, icing on the cake, is tax-free. Because if I earn, 8%, 10% tax-free rates of return, that would be like earning a 15% tax-deferred rate of return in an IRA or 401k. Because if you earn 15% and you pull out $150,000 out of $1 million nest egg, if you earn 15%, you have to pay a third in taxes, 50 to net 100. Because of the negative impact of taxes, that $1 million nest egg will be gone in about 11 years. So there's 3 big dangers that cause most investments to run out of money: taxes, inflation, and market volatility. So while we're trying to achieve liquidity, safety, rate of return, and tax benefits, you are doing it to eliminate the dangers of taxes, inflation, and market volatility. Now, to me, this is a no-brainer. but you wouldn't believe how many financial advisors never understand or learn how to do this. And so you can't be aware of something you're not aware of. And a lot of people say, well, how come I've never heard of this? It's because the broker-dealers don't want their advisors to know about it because they make money, frankly, by churning your money. If you put it over here, there is only compensation one time when you put the money in. It will sit there and grow and grow and grow. And so advisors can't keep making money on the money you're making the rest of your life. I'm just being honest with you. So before I share with you how you can learn more about these key elements and connect the dots, let me tell you what I would love for you to do. If this is resonating with you, please subscribe to this channel. It's Three Dimensional Wealth. This YouTube channel has over 500 educational videos on it. And I post a new video almost on a daily basis addressing a financial question that has been asked anywhere from 300 to 3,000 times a month for the last several months. And if you like it, share it with somebody who you think would appreciate learning this. Post a comment, click like. But subscribe, and when you do, click that little bell. Why? Because then you'll be notified every time I post a new episode. Stay with me here for another few moments because I want to gift you a copy of my most recent best-selling 300-page book at the end. Now, let's talk about what constitutes a perfect investment. Again, liquidity, safety, rate of return, and tax benefits in that order. Now, again, so many people get them in reverse order. Now, for this very purpose, my favorite vehicle I call the Laser Fund because it meets those key elements, liquidity, safety, rate of return, and tax benefits, better than any other investment I'm aware of in America. So in my book called The Laser Fund, Liquid Assets Safely Earning Returns, it spells laser, okay, liquidity, okay, safety, rate of return, LSR. You'll notice here 4 pillars on the front. So when we're looking at 4 pillars, this is about liquidity. This is safety, this is rate of return, this is the tax benefits. And in this book, you can rank or rate any investment, annuities, mutual funds, stocks, bonds, real estate, your house, whatever, any investment on a scale of 1 to 10, 10 being a perfect score in relation to liquidity, safety, rate of return, and tax benefits. And you will discover that some investments may rank high in liquidity or safety or rate of return, but you have to give up some of the safety or the rate of return when you have your money in a bank. Is it fairly safe? Yeah, but the rate of return is pathetic, 1%. And so there's a lot of investments that frankly only score out of 40 points. That's 10, 10, 10, 10. A perfect score would be 40 if you add up all 4. Most people in America have their money in investments that only score about 18 to 22 out of a possible 40 at best. My favorite vehicle, called the Laser Fund, which is a max-funded indexed insurance contract structured correctly and funded properly, it knocks the socks off of almost all of these others. It scores anywhere from 33 to 35 or higher out of 40. There is no absolute perfect investment, but the Laser Fund gets pretty close. In fact, it blows all the rest of them out of the water. Don't take my word for it. You read and learn why. This book will show you how to diversify and create the foundation for a tax-free retirement. So if you want to know what constitutes a prudent investment, I would recommend you study and you understand liquidity, safety, rate of return, and tax benefits. And maybe where you have your money is sort of not cutting the mustard. It's only there about halfway. I would strongly recommend you learn how to increase the score on where you have your serious cash up to at least 30 or 35 out of 40 on those key elements. Here's how you can claim your free copy. When you go to laserfund.com, laserfund.com, or click on the link below, you can contribute a nominal amount towards the shipping and handling, put a little bit of skin in the game, so to speak, and I'll pay for the book. It retails for $20. I will gift the book to you. It's 300 pages. And if you like to listen and learn or watch and learn, there's options there. There's even an 18-hour master class where you can do a deep dive if you would like. And frankly, a lot of people who have done that have saved themselves hundreds of thousands of dollars of unnecessary tax or losses from having their money exposed in the market. It's actually 2 books in one. This side, the white side, is for left brain thinkers. It's about 200 pages, 14 chapters with all the charts and graphs and explanations if you're a left brain learner. If you're a right brain learner, you flip it over, you read this one, 100 pages, 12 chapters, with 62 chicken soup for the financial soul stories on how to have liquidity, safety, rate of return, and tax benefits in the utmost way that you possibly can on your serious cash. I would strongly recommend you have at least 40 to 60% of your serious cash invested into a portfolio of laser funds for your brighter future.